In March 2013, the island of Cyprus woke to a silence that didn't feel natural. The glow of ATM screens, normally a symbol of modern stability, displayed a message no one expected. Withdrawals unavailable. For thousands of families, the money they believed was safe had instantly become untouchable. By sunrise, the truth emerged. Deposits above €100,000 were no longer deposits at all. They had been seized, converted into the rescue fund for the very banks that failed them. Most people saw it as a local tragedy, a small nation caught in Europe's financial storm. But this was not an accident or an improvisation. Cyprus was the first public demonstration of a new doctrine crafted quietly behind closed doors, a shift from governments saving banks to depositors saving them instead. This was the night the global bail-in era began. 4 countries have already followed and more are preparing in silence. In the years after 2008, the world learned a new financial vocabulary. Back then, the solution to a collapsing bank was simple. Taxpayers absorbed the damage. Governments injected money, debts were covered, and the public carried the cost. But after 2011, the definition of rescue changed. A bail-in is the opposite of a bailout. Instead of governments saving banks, the banks save themselves by taking the money already inside their vaults, your deposits. Most citizens never heard the quiet announcements made at G20 meetings, where world leaders endorsed bail-ins as the new global standard. They never saw the legal language that reclassified depositors from protected clients to unsecured creditors, placing ordinary people behind bondholders in the hierarchy of claims. The implications are still largely misunderstood. A bail-in is not a vote, a debate, or a public decision. It requires no new taxes and no money printing. It happens silently, mechanically, and legally. And the unsettling truth is that this redefinition of saving now applies everywhere, even if most depositors have no idea it happened. The shift was global, permanent, and ignored. Cyprus was only the beginning. In 2013, nearly half of all deposits above €100,000 were confiscated overnight. People who believed they were financially secure woke to discover almost 50% of their life savings had been converted into bank equity shares in a failing institution they never asked to own. It was the first major Western-style bail-in, but not the last. 2 years later, Italy followed, for regional banks collapsed in a single weekend, wiping out shareholders, bondholders, and depositors in one sweeping action. Families who had trusted safe savings products saw them vanish before Monday morning. The language had changed. The mechanism had not. In India, the pattern resurfaced in 2020. When PMC Bank and Yes Bank unraveled, citizens found themselves locked out of their own accounts. Withdrawals were capped at levels too low to cover rent or medical bills. The banks survived. The depositors did not. But the most devastating example came from Lebanon. Since 2019, the country has lived through the largest unofficial bail-in in modern history. Banks refused dollar withdrawals, forcibly converted deposits into near-worthless lira, and trapped an entire middle class behind the walls of financial collapse. 4 countries, 4 crises, one repeating sequence: fragile banks, unsustainable national debt, quiet legal adjustments, sudden account freezes, and forced seizure or conversion. The pattern is not theoretical. It is historical fact. For governments have already taken depositors' money and many more have positioned themselves for the same moment. Every bail-in begins long before citizens feel anything. It starts in stage 1, the silent debt spiral, when governments borrow faster than they can repay. The numbers look technical, abstract, even harmless. Yet each new loan pushes the system closer to the edge. Stage 2 emerges quietly in the banking sector, where non-performing loans rise and balance sheets weaken. This is the point when confidence begins to decay, though officials insist everything is stable. Stage 3 is where the real shift occurs. Legal language changes. Words like resolution authority, emergency powers, and unsecured creditor slip into new legislation. These phrases rarely make headlines, but they redefine the relationship between citizens and their deposits. By the time they appear, the framework for a bail-in already exists. Stage 4 is the first moment the public senses something is wrong. ATMs slow down, transfers stall. Banks reduce withdrawal limits, citing technical issues. In every historical case, these symptoms appeared days or weeks before the collapse. Then comes Stage 5, the weekend freeze. Banks close on Friday with reassuring messages, but by Sunday, the truth is announced. The crisis is already underway, and the options are gone. Stage 6 is the bail-in itself. Deposits are seized or converted, either into equity, restricted accounts, or devalued local currency. It happens swiftly, mechanically, and without negotiation. From Cyprus to Lebanon, from Italy to India, the same 6 stages repeated with remarkable precision. And the unsettling reality is that most nations today are somewhere between Stage 2 and Stage 4, even if their citizens cannot yet see the signs. For most people, bail-ins are something that happen over there, 2 smaller, weaker nations on the edge of the financial map. But the legal architecture for the next round has already been built inside countries that see themselves as the safest in the world. In the United States, internal FDIC discussions openly reference bail-in tools, while regional banks carry massive unrealized losses that depend entirely on low panic and cheap liquidity. The language and the pressure are both in place. Across the Atlantic, the United Kingdom's Bank of England has operated under a formal bail-in regime since 2019, giving authorities the power to impose losses on certain creditors and large depositors in a crisis. In Canada, bail-ins were fully legalized under Bill C, even as the country's debt-to-GDP quietly climbed to historic levels. Australia followed a similar script. In 2018, a law enabling bail-in style resolutions passed, with almost no public awareness and only a handful of senators present in the chamber. No national debate, no televised vote. Just a quiet legal switch. These are not predictions of imminent collapse. They are confirmations that the machinery is already installed. The next major bail-in will not require fresh approval, new votes, or noisy parliamentary sessions. It will simply require the right crisis at the right moment in a country everyone assumes is still safe. And when it happens, most people will call it unprecedented, even though the documents were public, the warnings visible, and the pattern written by 4 other nations. Deposit insurance is one of the most comforting promises in modern finance. The logos on bank windows, the government seals, the reassuring guarantees all suggest that no matter what happens, your money is protected. But the numbers tell a different story. In the United States, the FDIC holds only a few cents in reserve for every insured dollar. It works as long as only a tiny fraction of depositors need help. In a systemic collapse, the fund evaporates almost instantly. The United Kingdom learned this during the Icelandic iSave crisis, when the FSCs was nearly wiped out trying to cover a single foreign bank failure. Canada's CDIC functions the same way. These institutions were never designed to save the banking system, only to calm depositors. The real protection isn't financial. It's psychological. Deposit insurance exists to prevent panic, not to survive it. And when confidence breaks, the illusion ends. For decades, the middle class has lived on a shrinking foundation wages that barely move, savings eroded by inflation, and rising debt that fills the gap between hope and reality. In a bail-in system, this group becomes the ideal target. Their deposits are large enough to rescue a failing bank, yet their influence is too limited to resist the seizure. In Cyprus, it wasn't the wealthy who absorbed most losses. They had already moved their money abroad. It was teachers, shop owners, and retirees whose accounts were raided. In Lebanon, the same pattern unfolded as the middle class watched lifetime savings trapped and dissolved into worthless currency. When systems break, the elites move first. The middle class stays put, believing the rules still protect them. But in every bail-in so far, they became the default shock absorber. A bail-in is never the final chapter. In every country that has attempted one, the true collapse begins afterward. Argentina watched capital flee the moment accounts were frozen, draining the system faster than any rescue plan could refill it. Greece followed a similar trajectory. Once deposits were touched, confidence vanished, credit died, and the currency came under relentless pressure. Lebanon's experience shows the full sequence: bank seizures, followed by hyperinflation, political upheaval, and emergency controls that turned daily life into a struggle for basic access. These events reveal a consistent pattern. A bail-in doesn't restore stability. It accelerates decline by destroying the belief that money is safe. The cost of losing trust is always higher than the cost of losing money. Every financial collapse has a tipping point, and it rarely begins with empty vaults. It begins when truth becomes negotiable. Before a currency weakens or a bank fails, the quiet erosion happens in language, in reassurances, in the subtle redefining of what belongs to whom. A bail-in is not just a technical measure. It is the moment a society discovers the promises it trusted were written in sand. It signals that the social contract, once grounded in fairness and transparency, has been quietly rewritten without the public's consent. History is clear on this. Nations don't fall when banks run out of money. They fall when citizens run out of trust. And once that trust is broken, the decline accelerates faster than any policy can contain.